Hey guys, welcome. We're just about a minute away from start. We should be live. Oh, perfect. Oh, good. Thanks, Kyle. All right. Just make sure market's closed. 4 o'clock. It's go time. Nick confirming we're good in the members area at IEC. Thanks, Kyle. Almost dead. Okay, good. All right, perfect. Welcome, everyone. We're going to start right on time. I'm Todd Gordon, founder of Inside Edge and formerly Trading Analysis, which is going to live forever on the internet for free. All of the content courses we ever put out over 13 years. I just did a video this morning on that one. So, all good. Welcome. Happy Friday. Thursday. Feels like a Friday. Big time it feels like a Friday. Half day tomorrow for 4th of July. Markets close at 1. Tons going on right now. So I'm going to get in and out of here fairly quickly. A lot of content. We're going to move quickly. Kyle is not going to join today. He's on the chat doing a ton of client onboarding. A lot of new clients coming in and servicing the existing clients. So I'm going to fly solo today. Kyle, you are missed, and I know you're working hard behind the scenes. I'm working on a brand new setup here. I've gone fully over to Mac. So I think it seems to be working fairly well. I think we can watch comments, questions, insults, whatever you have. Throw them in there. I believe we can see everything. And if you're on YouTube right now, just type in, let me know. You can hear and see okay, and then we'll get rolling. Also, investors at Inside Edge, you probably are inside of my.insideedgecapital.com viewing this. We're going to do a public-only video update today in the interest of time. And everything I want to share today, I'm completely comfortable putting out there in the public anyway. Also, I have to get my butt to baseball practice tonight. All of my assistant coaches are not going to be there because they're going to the Lumineers concert here in Saratoga tonight. I'm by myself. And then also we have the Saratoga racetrack, the horse racing season kicking off here. So things are getting crazy. But let me just see again. I just want to see if I have any comments, questions, and we should be ready to roll. Okay. Good, I have it up. All right, let's roll. I have a good presentation for you, I think. Let me go over here, default scene, and there we go. Perfect. Okay, let's go. This is a little bit of a repeat. I'll be quick here, but I'm going to keep saying this for a while at least. The sort of member/investor area of Inside Edge Capital, which is my.Inside Edge Capital, is live. There's two sort of memberships or ways that you can access the members' content. or the investor-only content at Inside Edge Capital. The lower level is called Active Opps. This is a way to track my trading of the active opportunity portfolio, which is one of the 4 equity portfolios that we offered Inside Edge Capital. It's kind of your speedboat. It's more active swing trading in, out, not conscientious of tax implications. It's very cheap. It's a way for you to get an idea of what we're doing here at Inside Edge Capital. You can follow along on Savvy Trader, which is a third-party company that powers it, whereby I can send you text messages, push notifications, all sorts of fun stuff, track the portfolio. Again, if it's something you're interested in, it's like $300 for the whole year. It's so cheap, and it's really good technology. It's meant to take the place of my other business, which again led us to where we are here at Inside Edge Capital after 13 years. So it's a little bit of a holdover from that, and I am trading live investor money there. So that's Active Opps. And then the next level is called Portfolio Investor, which is either you're a full-blown wealth management client at Inside Edge, or you want to basically pay for it, but you retain control of your investment accounts and you pull the trigger yourself. You get full financial planning, tax advice. You get basically 90% of the experience of a full wealth management client at Inside Edge. Okay, but you guys have heard that for a few weeks now. You probably hear it for a few more weeks before I finally get rid of it. All right, so happy 4th of July. Today is the 3rd of July. This is just I was searching for any 4th of July pictures that I had here in my photos album and on my Mac, and this was a cute one down in Jersey. Those are my nieces and my boys, Jake and Brody. I thought it was so cute right there. But anyways, 249 years old we are, and as I say here, we're still in our infancy, navigating some social challenges in this melting pot. But a strong case can be made for a country with the greatest technological advancement, democratic principles, and economic opportunity of any country in history. And you can debate that. We can debate that all you want. But it's pretty amazing, this very, very young and extremely successful social experiment that is next year going to be 250 years old, which is kind of shocking when you think about it. So I, for one, am very appreciative of what we have in this country. By far is it perfect, far from perfect, but it's pretty amazing, and I think you may agree. And I'm not going down a political discussion at all. I have my political biases. But when it comes to managing money, my family's money, and your money, I am very easily able to compartmentalize and separate out any biases, and put our portfolios in the best position based on the overwhelming the trends in politics, geopolitics, what's going on in the economy, the fundamental sentiment, technicals of the market. It's very different than what you think is happening on the political end and its impact on the underlying economy, which the economy is not really the stock market. The stock market is quite divorced from the actual underlying economy, and how much impact does the political picture have on the economy can be debated. And as I said, there's the economy, and then there's the stock market, which many times are different animals. But the facts remain. The value creation that we have in this country, if you look at the market capitalizations, is astounding. It's kind of shaking to me when you look at this. I believe these figures are a couple years old at this point, but you look at the market capitalization, anywhere of, total stock market cap, Finland, Chile, Turkey, up to Australia, there's Iran, the UK, Saudi Arabia, and then here you have Nvidia, Apple, and Microsoft. Nvidia is a $3.5 trillion company, $3.6 trillion company at this point, so you can see those numbers are old. But Nvidia, Apple, and Microsoft are just, in terms of individual company market caps, just behind the entire market cap of Hong Kong, France, India, Japan. Here's China, and then there's the U.S. at $54 trillion. Okay, here's another graphic. This is the U.S. top 10 stocks versus global stock markets last summer. So the top 10 stocks, Mag 7 plus some others, at 18 trillion. There's the entire European Union, including Switzerland, France, Germany, Poland. There's China, Japan, India. So it's astounding the value creation, which, as I say back here, technological advancement, economic opportunity. I mean, those numbers, I think, speak loudly. So I think we have to be appreciative here in the somewhat holiday weekend and realize there's unbelievable opportunity. And, the pace of innovation with the digital revolution that we're going through is real. So let's not forget that as we're inundated with these, the headlines that both social and traditional media organizations are trying to bash us over the head with to capture our attention, to kind of serve their own their own intentions. I just came across this. This is something I can't wait to watch this weekend. I was kind of quickly going through it today in full transparency. Philip Afonso of, I'm not exactly sure the pronunciation, but it's a $55 billion money management organization. Philippe Lafont, he's an MIT guy. He was McKinsey for a couple of years. He worked under the legendary Tiger Management, Julian Robertson. He launched this fund in '99 with 50 million, close to where we are with assets, and now manages 50 billion. But there's a link for his keynote presentation talking about his opinion as to where we are in the artificial intelligence boom. And he is a very astute investor in technology, both in public and private markets. He was early in many of the mega cap companies that today. He's got positions in SpaceX and OpenAI, and he's very much regarded as one of the thought leaders in technology. And I have the link here, and again, I haven't gotten through all of it, but you kind of look at the various waves of technological innovation, and this is a screenshot from his keynote presentation of their what they call EMW conference, East meets West. But you look at the mainframe computers in the 60s, the PC in the 80s, networking with Cisco, and the hardware build out the internet in the 90s, and then desktop internet with Facebook, Google, and Amazon. And then we started to go to mobile and internet, Web 2.0, and then we just went through cloud. And now here we are with the artificial intelligence boom. And you can see, if this is drawn to scale in terms of the ebbs and flows of the tech build out, he thinks we're in very early stages. And I really like this graphic where artificial intelligence is powering companies in so many different industries that it's driving efficiencies. It's justifying these higher valuations than what we're used to, forward valuations in terms of expected earnings, because it's increasing the operating efficiency. And companies that do embrace AI are able to capture more market share. So what happened is like this virtuous cycle of, as companies do reduced headcount and increase their operating efficiency and leverage, that is going to drive inflation. If you ever heard the idea that technology is largely deflationary, this is the very first part of it. And as we have lower inflation, that's going to feed lower interest rates. The Fed won't have to raise rates, and hopefully we can begin to cut rates. We'll talk about that, which fuels higher GDP growth, higher GDP, the government collects higher tax receipts, and then that's the way that we grow out of our significant national deficit, $35 trillion, $6 trillion here. Somebody else that I've quoted on here, Rick Reeder, who I really respect, he says, we literally can grow our way out of the massive debts and then the debt to GDP, deficit to GDP levels that we're running. So it's a circle as technology is continuing to move forward. So I'm continuing to be very, very bullish here. The U.S. stock market broke to a new all-time high. There's a lot going on here. July seasonally is a strong month. We just passed Trump's big, beautiful tax bill. It got through the House by a pretty thin margin, got by the Senate. We had some economic data this morning with jobs report, which is pretty good. So we have the stock market at a new all-time high after a vicious April sell-off. And then, boy, did we get a V-shaped a recovery. Okay. Kind of going back to my old days where we really get into sort of the nitty-gritty, more advanced technicals. I just want to show you, based on a model that we look at called the Elliott wave theory. This is a chart of the S&P going back to even when the S&P was launched. I think it was like 1952, 3 or something in there. And I've superimposed the 1929 crash when the Dow was out there. The equivalent in the S&P would have been about here. Here's moving into World War II. Right here, markets rally up. And this model basically handicapping this whole thing in honor of the Saratoga racetrack opening here coming up. I prepped this chart in June 24, the S&P at 5,348. Today's the S&P is at 6,279. By way of the calculations that we looked at, and this is a methodology that's over 100 years old at this point, we could see the S&P approaching 10,000 and even 15 to 30,000 in the next 1 to 2 decades. So, the fact that we broke out here puts us in a really strong position. On top of, I just can't help but stress like how many macro headwinds that are scaring people out of this market that they think impacts the operating efficiency and the innovation that the tech boom is having, causing so many people to be underexposed to this market. Again, there's so much negative headlines, which again, that's the nature of social and traditional media, capturing, trying to vie and compete for your attention, which drives their clicks and their ad dollars. And it's a big contest for your attention, and fear is a stronger emotion than greed. And people, again, media organizations, social and new age and traditional, all try to compete for that. And again, everyone wants you to think that the sky's falling. And the more portfolios that we look at, the more people who we talk to who are astute investors, they just have, all these reasons why, the sky is going to fall. And unfortunately, it's cost them a lot with allocation to their portfolios, and it's changed their future, which that's a longer conversation. So, there's no guarantees on this. It's just a model that's well published and researched for a long period of time. And I could see the market going significantly higher and, life-changing money potentially being generated here. All right, let's get into those geopolitics. As I mentioned, the House passed the bill. This is a quote right from CNBC. I didn't want to rewrite it in my own words. I'm just quoting right from CNBC. The CBO warns the bill could add 3.5 to 3.4 trillion to the 36.2 billion of the world's largest economy existing debt over the next decade. Okay. What the heck does that mean? 3.4 trillion to the 30. I literally copied that. That's a error on CNBC. That should be trillion. 36 trillion of the world's. I literally copied and pasted it. The White House contests the CBO's estimates and labeled the agency as partisan. So the White House is fighting back on the CBO's estimate of adding 3.4 trillion to 36 trillion of the world's largest economy existing debt. And as I mentioned, based on the chart back here, if AI is going to follow the path that we're looking at here, we quite literally can grow our way out of that and work down on that debt. The mega bill push has taken place is a time of the broader economic volatility. Trump presses ahead with protectionist trade policy. That's the onshoring, reshoring of trade, as we know. And we are coming up on the July 9th, which was the 90-day kick the can down the road for reciprocal tariffs. So when we come back from 4th of July, we're going to have to contend with that. So we will see what happens. We also got some jobs data that was solid this morning. The non-farm payroll right here came in at 147 on expectations of 111, and there's a prior revision higher. So jobs were stronger than expected. Private payrolls missed. Okay. Average hourly earnings were a little bit lower, so month over month, year over year. So not getting that wage inflation push. And what that means is basically, we're not quite getting the inflation that we would expect. It was a strong number from the headline payrolls. And what I did is just took a little 60-minute snapshot of the reaction to the data. And what you can do is you can kind of handicap how macro investors interpret the data by looking at the various macro markets. 10-year bonds dropped. This is the price of the bond, which means the yield pushed up. Okay, gold, when yields push up, gold would generally push down. The dollar moves up. Gold and the dollar generally move opposite of one another. And the S&P futures went up. So what does that all mean with rates? Well, what happened was with the strong non-farm payroll numbers, strong jobs, it took the chance of a July cut from 76% yesterday. Sorry, let me say it again. It took the chance of no July cut from 76 to 95. So it increased by 19% that we do not cut the Fed funds rate in July, and that we actually go on hold. Okay, so we were at 23% chance of a cut in July. Now we're at a 4.5% chance. Okay, and if we look at the glide path of aggregated probabilities of where the Fed fund futures traders see rates going, we're at a 95% chance, as just mentioned, that there's no change from the current level of 4.25 to 4.5 in the Fed funds, and now we're down to a 70% chance of going down 0.25%, which is 25 basis points in the September meeting. Looks like best odds are in hold in October, and then there's a 95% chance that this can change, that we're down to 3.75 to 4. So the market's basically pricing in 25% cuts, though the July cut, which had a 3/4 or a 25% chance roughly of happening, just got eliminated, and that can happen again. So do I think we need to cut rates? No, I don't. I really don't think. And I know Trump is threatening Powell's life and intellect and job because we need to cut rates, but I don't believe we need to. And the markets are pricing in. You look at 2-year expected inflation out of the St. Louis Central Bank, Fed Bank. We're at about 2.3, 2.4% is the expected inflation over the next 2 years. The Fed's target's 2%. So it'd be nice to get that down a little bit. Housing prices are coming off. Crude oil is well under control as we're de-escalating with Iran and Israel, which we'll talk about. So, if we can get a little bit further downward pressure and get down to the 2%, it's fine. I'd rather see the Fed keep some elevation at 4, 4.25, 4.5 for when the next shoe drops. They have elevation to cut the rate and counter any market volatility that's introduced. All right, so talking about Iran and Israel, here's the ETF that tracks Israel. It's ripping. Okay, this is a daily chart of EIS. This is the ETF that tracks the Israeli stock market. This is 2025, so here we are halfway through the year. We've gone from $75 to $96. Little technical analysis that we like to do. Percent distance traveled in this swing right here is equal to this. And when you break through it, it oftentimes points to this level. So the Israeli stock market could continue to rally, as the ceasefire is here. So a couple reasons that it's happening. De-risk after renewed ceasefire, the Iranian nuclear capability eliminated or severely damaged. Israeli economy has been very resilient. According to Reuters, and I linked the article right here, 9 billion inflows in the first half of 2025 in Israel as bombs are flying. That's how markets work. It's sick and twisted, but that's how it works. Currency tailwinds, the Israeli shekel right here. So this is the dollar against the shekel. And what this means is that if the chart's going down, the dollar's selling off. and the Israeli shekel is rallying. The dollar ILS is moving lower, which lower dollar around the world generally means higher stock markets. And that shows foreign flows into Israel to buy the shekel, to buy Israeli stocks. Okay. EIS, this is the Israeli stock market. It has a lot of technology, cybersecurity, and defense contractors. So, that is, areas of the market that are very good right now, especially defense, and that's because, of the war tensions, cybersecurity, but obviously a lot of technology in Israel. So the market is discounting that the ceasefire is going to remain as the U.S. entered the conflict, and that's how markets worked. It happened in the first Gulf War and second Gulf War. As soon as the U.S. was involved, crude oil sells off and the stock markets rally. That's kind of how markets work. Crude oil, also you can kind of handicap how macro traders feel like this is going to go. We got a little bit of a bump here. We're down around like $56 in crude oil and went up to 75, and we've backed off. We're below trendline resistance. I don't know why this is not showing a spike in the volume in crude oil, but it did show the spike in volume here in the USO, which is the stock ETF that tracks crude oil. So there's the bump, but we're still very much under resistance in crude. So, I don't think we're going to get too much inflationary pressure while crude is below, this downtrend line. It's 70, 75 area right here. Okay. This continues to be, one of the most hated and distrusted rallies, stock market rallies of all time. This is from the AAII, American Association of Institutional Investor, I believe is what AAII stands for. And it sends a survey out. It's like newsletters and money managers and different insiders. Only 35% of responding investors are bullish right here. Percent of investor sentiment that's bullish. Percent of investor sentiment that's bearish is 40. The difference, 40 and 35, is -5. So you can see that, as the stock market's at all-time highs, on the margin, on the balance, people are still bearish. They don't trust it. Again, for all those macro headwinds, the scary news headlines, people trying to convey a message of fear and that we're on the wrong track, and it's the sentiment readings out there, right? This sentiment will improve when, with an asterisk, the market rips through all-time highs and the catch-up Johnny-come-latelys rush in, and that's when you're going to see this bull-bear spread improve. This is the actual allocation. So there's a difference between sentiment, how people feel, and what people are doing. And what's happened in orange, this is the stock allocation, only 64.3%. Allocated towards stocks. And what's interesting is we're at 64.3, which you can see in this orange line is low as the market is at all-time highs. The last time we were down around, low 60s was the late 23, low in the S&P. And 2022, inflation, interest rate spike, we made one more new low, but that set the bottom. Like the AAII stock allocation is at levels where the market should be selling off. And we already did sell off, but it's not really recovering. Again, it's a massively distrusted stock market rally, which, let me be a little emphatic on this point. We're long, we're very long. And I think once people realize that the scary macro headlines are not going to as significantly impact the economy, which I made the earlier point, is a pretty big disconnect between where the stock market is, they're going to rush in and they could ramp this thing. I don't know. It's not a forecast, and that's hopefully why you're with us, because we can change course and adjust within an hour. The firm-wide portfolios, but I feel like there's going to be a rush into this market, and that's going to be the late coming, generally retail public and some institutions. And that's when we're going to be enjoying, gains, but also when things feel really rosy is when it's best to look the other way. Things don't feel really rosy right now. Okay, I got to get moving. Total money market is $7.4 trillion in money markets. cash in the sidelines and just making the same point. Here's cash in retail money markets, 2.16 trillion. Cash is not yet going into the stock market. To my prior point, it's going into money markets. Nvidia makes a new all-time high. Nvidia makes a new all-time high. It's crazy. Okay. I'm not going to go into it again. I got to kind of get moving. I can't believe I have to say baseball practice. The kids are going to kill me if I'm, and the parents, it's like, where are you, Todd? You're not a full-time baseball coach? No, I'm not. But Nvidia makes a new high. It's the granddaddy of the AI revolution. It's not overly expensive. You know, if you look at next year's expected earnings of 535, you divide that into the price of Nvidia, which is 157, roughly going to get you about 38 times forward earnings. The S&P is at about 21 or 22 for a company that is literally the granddaddy, the champion of the AI revolution. You look at the earnings and the sales growth growing 125%, 114%, 50%, and then next year they're only expecting 25%, which that number can be increased. Here's the analyst median and mean projections for 2025 in Nvidia. We're trading about 160 right now. The average is about 173, 175. There's a new analyst that came out, Loop Ventures, where I put a price target at $250 in Nvidia, giving it like a $6.5 trillion market cap. Is currently we're at $3.9 trillion. It's insane. We hold a pretty good allocation in Nvidia. We have a 9% allocation in TAG, Tactical Alpha Growth. We have 3.5% allocation in SIG, Strategic Income and Growth, which is our dividend portfolio, and Active Opps, which I described earlier. We have a 6.81% allocation. So we're pretty long, but keep in mind the S&P right now I think is like 6.8%. Let me look up that real quick. S&P 500 stock holdings percent. I think it's 6.86. It's important. Nvidia is 6.89 right now. So, we're 50% overweight in our growth portfolio. We're actually underweight in income. And believe it or not, Nvidia does pay a yield, a very small yield, so it qualifies for a dividend portfolio. So, don't be surprised if we get heavier in Nvidia. Bitcoin is another one. There's a lot going on here. I was on CNBC last week, June 24th. I guess it was 2 weeks ago, talking about Bitcoin. And these are the 4 talking points I sent to the producer. Bitcoin is kind of having an identity crisis. They were like, why wasn't it rallying during the Iranian-Israeli conflict as it's a safe haven? I was like, well, I don't really think it's a safe haven. It's more of a risk-on sort of growth-oriented product right now. And there's a lot of interesting things going on with Robinhood and the tokenization. Bitcoin is being held on balance sheets of a lot of corporations, so it's becoming more correlated with the growth trade. I'll let you read through that if it's something you're interested in, but we are also holding pretty significant 3% allocation in Bitcoin in our growth portfolio, which is TAG. Okay, so that's going to be it. Very kind of quick to the point presentation. I hope that helps, and I'm sorry to rip through that, but again, Kyle's not here, and everything I wanted to share was just kind of public here. No specific investor-only content this week, but we will resume next week. Kyle will be here in Saratoga for 2 weeks, so we're going to be doing it together, which is great. Investors, let us know if anything's popping up. But we have both eyes, on the markets, and any tax, any planning questions, who to reach out there. Kyle, Nick is always there for us as well on the customer service side. But we're good. So I wish you guys a happy 4th of July, half day in the market tomorrow. I'm going to try to take it a little easy. I expect markets to be quiet, but let us know if we can do anything for you. All right, guys, we're going to leave it there. All the best, and I'll talk to you guys soon. Now, how do I turn this thing off? See you guys.